Hello everybody. So today I want to cover two stocks that reported their earnings this past week. One of them that I own, which is Nubank, and another one that I follow that I don't own at this point, which is Dutch Brothers. Dutch Brothers is a coffee shop, and Nubank is the leading neobank in Latin America, first and foremost Brazil, but they have also entered new markets like Mexico, for example. And Nubank is a company that is doing so well as far as everything in the funnel. I can't even describe how well they're doing. I mean, the customers, like clockwork, every single quarter they add millions of customers. We have now 95 million customers, right? So at some point in 2024, they will have 100 million customers. The revenue growth is also outstanding, growing at 82% CAGR. Customers growing at 30%. You recruit the customers today, they will earn you the revenues in the future. And then gross profit is up 111%, right? That grows even faster. And they've just started to turn on profitability, which I think is one of the reasons why this company is outstanding. It's actually, a top 15 position, about the same size as SoFi for me. And if you follow the channel, I love to invest in Brazil. One of my biggest position is StoneCo, which is which is the square of Brazil, so somewhat of a similar market, different business, of course. One point that I think is important to look at is their RPAC, the monthly RPAC. So that is the revenue per average customer monthly, and they are right at above $10 right now on the monthly average customers. $10.06 US dollars is the average amount of money revenue that they take in, right, per customer, and that costs them monthly, right, and that's the monthly. So the monthly RPAC of 10, right, and remember you do 95 million times 10, right? That's the monthly RPAC of 10. So that's the number that you get. And then you subtract to that the cost to serve the customers. And what's stunning is that the cost to serve the customers is 90 cents per month. So it costs them 90 cents per month, and the customers now earn $10 a month. So that's so fascinating, the scale that this company is getting. Because if you look, over more than a year, the cost to serve a customer has not changed. It's still 90 cents per customer. But the RPAC itself, right, the amount of revenue earned for customers has been consistently increasing. And as you can see, the older the customer gets, the more each customer brings to the company. So when a customer just signs up, they don't bring any revenue, right? Customers 5 months in, 9 months in, they don't make much. They make $5, $6. But then look over time, look after, say, a 5-year period, the customers cohort, some of them start earning, $25, $30 a month, right? You have the early cohorts of Nubank, they are earning $30 and they are still costing 90 cents to serve. So this is a business that can have some exponential growth in the numbers. I absolutely love the numbers of this business. Now, it's the uncontested winning neobank in Latin America, but what about the valuation? Because I think you will find a consensus when you research this company that this is, kind of the Nvidia of fintech in LATAM in a way. That makes some sense. The question is the valuation. Well, the valuation on Nubank is outstanding. So I kind of redid all of the calculations, tried to go back through the numbers, and using my, my kind of signature metric for the channel, which is enterprise value over gross profit over revenue growth. And I went back into the numbers, calculated it maybe a little differently because I use an annualized number on this one and not the trailing 12 months number. So take that with a grain of salt. But going through the calculation, we see revenue is 2.5 billion, gross profit 1.1 billion, and net income, which is the metric that they are putting forward. I typically prefer adjusted EBITDA, but I'm going to use a net income for this one. So that's a 361 million. So you annualize that. So you do a 4x for each of them, knowing that they have very consistent growth. So I have no problem doing a 4x for each of them. It's actually going to be more than a 4x for a full year for each of them. What are the valuation that you get? Well, you get a company trading at less than 5 times revenue. You get a company trading at about 10 times gross profit. And you get a company trading at 36 times enterprise value over earnings, which is very similar to PE for this stock. EV and price market cap is similar for this company. So again, if you're into PE, you may say, oh, 36 is a lot, but actually, if you look at analysts, the predicted growth from analysts is 42%. So even if you were to do a PEG ratio, you'd be under 1 on the PEG ratio on this. But of course, on this channel, I don't do the PEG ratio. I do my own metric, which is I look at gross profit, because in the case of Nubank, I trust Nubank to invest in the business, to reinvest in the business, to do good investments. Actually, if you listen to the conference call of Nubank, you may know that 40% of the employees of Nubank are working on future projects, future expansion. They're not working in the day-to-day. So this is a business that is creating a lot of optionality for it in the future. And if I use that metric, if I use all of these numbers and I trust them on the gross profit, I trust that they will invest that right. I'm using the enterprise value over gross profit over revenue growth metric, which I don't use earning, I use gross profit. If I do that, and I do that calculation, and by the way, for those who have asked in the comments section, how do I do this calculation? Well, it's quite simple. It's you get the enterprise value in billion, you get the gross profit in billion, and you divide it by the revenue growth, but you don't express that revenue growth as a percentage. You express it as a plain number. It's kind of a rough and ready back of a napkin calculation. It's not the most scientific thing, but it's how you get this number of a 0.24. This is how I calculate it in my spreadsheet. So I get a 0.24 when I apply this calculation. That would be in the top 25% cheapest stock in my spreadsheet for a stock that is clearly very high quality in my view. If you do the rule of 40 on this company, what you would do is you would take 42% predicted revenue growth, and you would add to that the margin, right? So that's net income margin in this case. I usually like to use EBITDA margin, but net income margin is what we got for Nubank, so that would be a 15, and they've achieved the rule of 57. So in the case of Nubank, not only do they score cheaply still on my EV over GP over revenue growth metric, but they also exceed the rule of 40, the rule of 40 being what SaaS investors consider an attractive business. If you have 40 or more, you're considered an attractive business in the VC world, and they're at 57. So that's pretty attractive. Very happy to own it. Happy with my position. I wish the stock had dropped a little more. It did not, but I love to own it at these prices. And this is kind of a steady Eddie, sleep well at night company, kind of a Mercado Libre, and even a StoneCo. I'd go as far as StoneCo is a little bit like that. So I'm very happy to own it now. Moving on to another stock who just reported its earnings, and this stock is Dutch Brothers. So Dutch Brothers is a company I started covering for our channel. Many of you have suggested it in the comments section. There's a lot of things that I like about this business. Very small footprint, no dining room. It's just a drive-through coffee shop. The car comes in, you sell the product, they leave, you make the money. Simple business. And this business is growing very fast. Let's give them that. They are growing very fast for a business operating in the physical world. You're dealing with permits to build new location. You're dealing with authorization. You're dealing with brick and mortar. You're dealing with contractors. This is not as easy as scaling a tech business. You're scaling in the physical world. But kudos to Dutch Brothers for A, growing at the level they are, and then B, giving us an outlook, a 2024 outlook. Many companies don't take that risk of giving us an outlook, likely a sandbag outlook, as they always are right now in the interest rate environment. But nonetheless, I'm going to use the middle point of their outlook to do my valuation for Dutch Brothers. So what they've guided essentially with this outlook, with 24 outlook, is 24% revenue growth, which if you know the channel, I like to have more than 30%. So that guided revenue growth for me right off the bat is a little disappointing. But that would be okay if I didn't see the fact that most of that revenue growth is going to come from them building new stores. Very little revenue growth is going to come from the same stores, right? So the same store growth is going to be in the low single digits. So that's a big range, 1 to 5%, but still low single digits. So most of that growth that they expect in the revenue is going to come from building new stores. And of course, it's a lesser quality growth because it's capital intensive. They're going to invest the cash that they raised when they went public. So, kind of a lesser way to grow in my view. I would love to see, double-digit growth in the same shop sales, right? The brand itself should also see more growth. But anyways, I'm kind of a growth snob, so that's why I'm kind of like, this is low, because I'm spoiled with a lot of more digital app-based companies. Anyways, let's do this calculation. The enterprise value is $3 billion, gross margin 31%, revenue growth 24%. So I do enterprise value over gross profit over revenue growth. My gross margin is 31% times 966 million. That's how I get to 299 million in gross margin. Enterprise value is simply you subtract the debt that they have, right? And the growth is 24, so you get a 0.42. That's not the cheapest. That is cheap. That is cheaper than the average stock that I follow on this channel. But it is not the cheapest, and it is definitely not as cheap as I would like to be for that sector, right? To be invested in the brick and mortar sector, in the sector of all of these local regulations, to be invested in that, I would really want to see something cheaper. Let's not forget, this is a business operating in the physical world. It doesn't scale as fast when you sell coffees, right? Especially when you sell a product that's $5, right? It's $5-6. You gotta do volume. You have to do volume. At some point, your growth is constrained by the physicality of the business. So that's one reason why I said it's not the cheapest. Another one is the guided adjusted EBITDA, 190 million. So we got to calculate the EBITDA margin. As you know, for my rule of 40, I like to use EBITDA margin. So that would be 1.19, divided by 1.2. You get a 16%. So 16% EBITDA margin is what you have. 16% EBITDA margin right here, plus 24% of growth. You get exactly a rule of 40. So kudos for them. Good for them. They've made the rule of 40. So they have a rule of 40 going for them, which is impressive because they operate in the physical world. So the conclusion for Dutch Brothers is, if you must be in that physical world business, if you must be in the brick and mortar restaurant and beverages business, if you like that business, if you've tried the brand, like I have not tried that brand, but if you've tried the brand and you love the brand, then, I could see why someone would be interested in investing in that business. In my case, I still would like it to be much, 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 much cheaper. But anyways, interesting company nonetheless. Thank you for all of you in the comment section for suggesting it. I'll be waiting for a cheaper price or not getting in right now. I find it expensive for what you get. So anyways, this was not investment advice. No financial advice ever on this channel. This is just entertainment. Hoping you were entertained. Please like, please subscribe. Thank you for watching and have a wonderful day.